Dialogue. The U.S. market has been experiencing wild swings, driven in part by uncertainty stemming from U.S. tariffs on global trading partners. As a result, fears of a looming recession are growing. Meanwhile, the Organization for Economic Cooperation and Development, or OECD, has downgraded its U.S. growth forecast for this year from 2.4% to 2.2%. So is the U.S. on the verge of a recession? What's behind the economic downturn? And what do we know about proposed Mar-a-Lago Accord and its potential impact on global trade? Join us for today's discussion from Beijing. I'm Xu Qinduo. Joining us for today's show are Professor Steve H. Hanke from Johns Hopkins University, David P. Goldman, Deputy Editor of Asia Times, and Professor Bert Hofman from the East Asian Institute at the National University of Singapore. Welcome to Dialogue. Professor Steve Hanke, we'll start with you. You know, the OECD has downgraded its U.S. economic outlook, cutting its GDP growth for 2025, the forecast, of course, from 2.4 to 2.2%. I want to know, what do you make it?
Well, I'm not too surprised. The main reason for the revision was the threat of Trump's tariffs. However, I think the background is interesting for me because I use the quantity theory of money to indicate where the course of the economy is going. And all that says is if the money supply is going up, the economy is buoyant. Real GDP goes up and inflation goes up. On a converse side, if we have a contraction in the money supply, we have a slowdown in real GDP and a slowdown in inflation. And in the United States, since the summer of 2022, the money supply has actually contracted. The stock of money in the United States is a little bit lower now than it was in the summer of 2022. And the growth rate in the money supply, measured by M2, is also very anemic. To hit the inflation target on a sustained basis of 2% in the United States, the money supply would have to be growing at about 6% per year, and it's only growing at 3.9% right now. So this, to me, indicates that we will have a slowdown in the economy because following changes in the growth rate in the money supply, you will have a slowdown in the economy if the money supply is contracting. We've only actually had 4 of these contractions in the history of the Federal Reserve since 1913, and all of them have led to recession. So that part of it, I think, is kind of baked in the cake, in the sense that the money supply went down quite some time ago, and with a lag, it gets transmitted through the economy and starts slowing the economy down. So that part is kind of in there already. And the new element is Trump and tariffs. That's the new factor. And of course, that led the OECD to downgrade its forecast for real GDP growth. By the way, the forecast for real GDP growth in Canada was reduced by about 50% from its prior OECD number, and Mexico's was reduced dramatically. They're forecasting an actual recession in Mexico this year, and virtually no growth in Canada, 0.7%.
Okay, so yes, David, Mr. David Goldman here. Obviously, I mean, the fear of recession has something to do with the tariffs, in particular. Let's say uncertainty. Tariffs with neighboring countries, Canada and Mexico. At the same time, if their economy is reduced to like 0.7 or basically very little growth, so that will also have an impact probably on the U.S. economy.
I wouldn't blame the tariffs quite yet. Treasury Secretary Bessent said, I think quite correctly, that we have already been in what he calls a private sector recession. In other words, under the Biden administration, We had extremely high levels of federal outlays for individuals in the form of various subsidies, starting from the COVID crisis. That's the principal reason why we've had a government deficit in excess of 6% of GDP, which is unprecedented for a non-recession peacetime period. So as government spending slows, as it must, we have the threat of recession. Investment overall was already down in the fourth quarter. Now, tariffs, depending on how they hit and how big they are, may not be a big factor. If we have tariffs in the 10 to 15% range, I would look at that as the equivalent of a 5 to 7.5% value-added tax. We'd get a one-time increase in the price level of 1 to 2%, which is quite manageable, and perhaps $300 billion a year in additional tax revenues. The Trump administration is using tariffs as a bargaining tool, involving a number of factors, including cooperation from Canada and Mexico on controlling fentanyl exports to the United States, illegal immigration, and so forth. So depending on where they settle, this may not be a big factor. The main problem is we're coming down from the sugar high, or if you will, cocaine high of the Biden years. And there's no doubt but that the economy is going to be subject to headwinds. Whether this recession really depends on whether affluent consumers continue spending. And that's something which is very difficult to predict.
Professor Bert Hofman, of course, looking at the tariff, of course, on countries, trading partner of the U.S., from Singapore, from Asia. What do you make of it? At least the people would say, they are related to, say, the stock market probably, in slump for quite some time, because, people obviously don't want to see, too much tariffs, or because tariffs will create uncertainty there?
Well, first, it is remarkable how 3 months ago we were looking at a very thriving U.S. economy driving world growth together with China, and now we're actually talking about a recession. I think that talk is overdone, but there is more concern about a possible tail end risk of a recession right now. In part, and I agree with David, that some fiscal consolidation is necessary. The way the Trump administration is going about is let me say, very original. But the key uncertainty is about the trade policy, and let's not forget the investment policy. And the way that is currently being implemented creates a lot of uncertainty, because all we have seen thus far is tariffs on Canada, tariffs on Mexico. The announcement of the America First trade policy would mean tariffs all around the world, and that would be very damaging for the U.S. economy as well as for everybody else. And the OECD has a very mild projection of a 10% tariff on everybody and retaliation, and you come to a 0.7, 0.8% lower GDP for the world 2 years from now. Look, in Asia, the uncertainty is, well, are we going to be on the receiving end of this America First trade policy? There's been an executive order of the President of the United States just to investigate who is treating the United States badly, and that includes anybody that runs a surplus with the United States, anybody who has higher tariffs than the United States. And unfortunately, especially for Europeans, but a lot of Asians as well, President Trump believes that a value-added tax is also a tariff. So on the basis of that, we're going to have a reciprocal tariff on everybody. And that creates right now a lot of uncertainty. So that, I think, is the main driver of the markets. And it is to some extent the main driver of the correction in the United States. The uncertainty alone, according to Goldman Sachs, would knock off 0.3% of GDP growth in the United States. And over time, once reality kicks in, once we know what these tariffs are going to be, it may be damaging for many more countries.
It's interesting. Sorry.
Yeah, go ahead, David.
If I may, it's interesting that The country which has gotten the biggest tariff so far, China, has the best performing stock market. And the worst performers have been the Southeast Asian countries, for whom no tariffs have yet been announced. The least economically sensitive stocks, namely U.S. tech stocks, the so-called Magnificent Seven, are the worst performers in the U.S. market. So I don't think everything can be blamed on tariffs. The markets, if you look at the markets in terms of the segments, there are other factors at work. For example, competition from China on artificial intelligence, DeepSeek versus ChatGPT. There are many other factors here.
Yes, Professor Steve Hanke. So obviously, you have talked about the quantitative, theory there, not only the tariffs. But let's imagine in April, more tariffs on more countries, and then more retaliatory tariffs on the U.S. side. What will happen? What's the impact? Are we having a global trade war? And what does that mean to the U.S. economy and the rest of the world, maybe?
Well, I think this is very interesting listening to David and Bert, because David is more or less presenting tariffs like we know what they are. I mean, and he's talking about an optimal tariffs and things like that. But that's not the situation we're in. Bert mentioned the uncertainty aspect. And I think we're getting into what is really called regime uncertainty. It's not just the tariffs themselves. It's the whole regime in the United States. Bert kind of alluded to this when he said diplomatically that it was an unusual approach to economic policy. It's an approach that contains a tremendous amount of uncertainty with very large changes. Now, let me give an example. The classic regime uncertainty story was, of course, the New Deal and Franklin Delano Roosevelt when he was president of the United States. And we had, remember, in the Great Depression with the New Deal, they said, happy days, we're here again. That was the propaganda that everybody loved the New Deal. Everybody loved Roosevelt. It was just wonderful. Well, the regime uncertainty aspect was a disaster. It prolongated the Great Depression a great deal and drove the stock market. The stock market from peak to trough lost 86% of its value during the Great Depression. And most of that was due to regime uncertainty. And why? Because they were changing the rules of the game all over the place. Subsidies, nationalizations, increased taxes. Everything was being changed. The whole regime was being changed. All the rules of the game were being changed. And that's basically what the problem is with Trump. And I think it will simply add to what I think fundamentally is a slowdown that's baked in the cake because of this slowdown we have had in the money supply.
Professor Hanke here, the Trump administration has, basically responding to the market concerns, saying that this is an economic transition. Okay, transition to what? So what is the logic, what is the thinking behind this so-called transition, and to what stage, to what goal?
If you believe what words coming out of the administration, it's to make America great again, to increase the potential growth rate in the United States. So the potential growth rate is a little over 2% per year, and they want to get it up to about 3% per year. Mm-hmm. That's what they say the goal is. As I say, the potential in the U.S. is about 2.2. Mm-hmm.
2.2. David, if you look at the talk, the remarks by the government, of course, they are looking at, say, revival of the U.S. Manufacturing sector, reindustrialization. Okay, export more to countries, right? To have a trade balance, probably a fair trade, so-called. And then there's this proposed like a Mar-a-Lago Accord. Is that behind the idea of, in what way the government behaves in terms of its policy making on trade, on industrial policies?
I think policy is very fluid at this point. I think President Trump is exactly right to point to the very rapid growth of American debt and warn that we will eventually have a debt crisis if we don't rein that in. Uh, he's said publicly, of course, that he'd like to have a strategic agreement with Russia and China on armaments that would allow him to cut the defense budget in half, which is a noble and praiseworthy goal. And a good part of the reason for tariffs is to raise revenues. He's trying to accomplish several goals at once. Another is to increase exports and reduce imports. Now, I think that tariffs by themselves or currency manipulation will not be an adequate basis for that. We have many problems in the United States. One is as biggest, maybe a shortage of skilled labor. We have many disincentives to investment. I think Trump is a pragmatist. He places a great deal of emphasis on tariffs, perhaps too much, but tariffs certainly can be part of the mix. Now, the idea of a Mar-a-Lago Accord for a big depreciation of the dollar, that was an idea circulated by Steve Mirren, who's the White House economic advisor when he was a consultant for a hedge fund in Canada. It's difficult mainly because the capital flows into the United States in the last several years have almost entirely been driven by tech stocks, by the boom in the U.S. stock market. Getting people to central banks to play with their portfolios of U.S. treasuries is not going to do very much because that simply hasn't been a big factor in the last several years. The great risk in depreciating the dollar is that you get higher interest rates because foreigners don't wish to hold U.S. bonds. We already are paying $1 trillion a year in interest, triple what we were before the Fed raised interest rates. That's a very dangerous level of interest payments. And if we can't get interest rates down, then we end up with an Italian problem that the interest rate on the debt is so big that it keeps the deficit perpetually high. So we don't want that either. So at least in the form I've seen it, I don't think a Mar-a-Lago Accord is workable, even if other countries would agree to it. And I think that's far from likely.
Professor Hofman, the goals are reasonable, right? To deal with the debt crisis, to export more, to reduce trade imbalance, things like that. I think it does make a point. What's your opinion? Do you think the Mar-a-Lago has a point? That's the way to go for the government?
So let's do the two things. So, I mean, on the tariffs, it's clear that Trump one had tariffs and it didn't really work. What did start to reindustrialize the United States was under Biden, the CHIPS Act, the Inflation Reduction Act, the manufacturing construction went through the roof, and now the administration is cutting that. So it is a bit confusing. Instead, they take tariffs, but the tariffs are largely on intermediary goods, which actually undermines the competitiveness of manufacturing, of final manufacturing, on steel and aluminum and others. And that undermines the competitiveness of United States products. So it's a bit confusing on that side. I'm not sure whether it would generate enough revenues to give a major dent into the deficit. But on the positive side, and that is quite frustrating. On the positive side, the deficits on the trade balance of the United States are a sign of the United States' success. Everybody wants to have a little piece of the success, and be it shares or be it otherwise, they want to be in the United States, so they invest in the United States, and that means that the United States can actually spend more than they produce. So that's a really good thing. Yes, there's been some unemployment consequences, but they have been relatively minor. If you look at the China shock, which is a big deal in the United States, that was probably no more than 2 months of usual turnover of employment in the United States. So it's politically very much used, but actually it's a relatively small thing. On Mar-a-Lago, and David has already said a lot, and I agree with most of them. I don't see it work, but the main reason is I don't see any takers. Everybody remembers in Asia, everybody remembers the Plaza Accord, everybody remembers the Louvre Accord, and it didn't work out so well for the main target in Asia, and that was Japan. Japan made their own mistakes, and I think the domestic policy was a big part of those mistakes, but the agreements in Plaza and Louvre were part of basically in the end the demise of Japan's growth by the early 1990s. So China has studied that very, very carefully, and they don't want to be part of an agreement like that.
Professor Steve Hanke here. Okay, the Mar-a-Lago Accord, weak U.S. dollars, reindustrialization, debt crisis. Can the U.S. government achieve all the goals at the same time? Because if you have a strong U.S. dollar, that gives you extra territorial judicial power. That's why there are U.S. sanctions against other countries. If you have a weak U.S. dollar, there are concerns other countries may, have a further distance from the U.S. dollar, rely less on the U.S. Is that a good thing for the U.S., etc.? What do you make of it?
The big problem, and it's kind of been alluded to by both Bert and David, is that Trump has a lot of ideas. A lot of them are contradictory and really just don't make any sense. There's one idea that he has, however, that it's something that's always consistent with Trump, and that is he thinks trade deficits and current account deficits are bad, and they're created by foreigners manipulating the United States in a bad way. It turns out that the trade deficits are actually made in the United States because we save a lot less than we invest. And that gap in that savings investment identity is made up by importation. And it's easy to finance, as David has indicated, because everybody wants to be in the United States and in dollar-denominated assets of one sort or another. So the deficits are a good thing, not a bad thing. It does allow us to consume and spend a lot more than we produce. So his basic premise for all this tariff stuff is just total rubbish of the highest order. Anyone who knows anything about economics knows the savings investment identity. They know how it works. And there's nothing that tariffs are going to do to change the trade balance in the United States. They will only change the allocation of the sources of who's filling the deficit. But the aggregate deficit's not going away.
David, okay, what should the U.S. do if not the tariff alone?
Well, I think tariffs can be a very useful part of the mix. Perhaps Trump places too much emphasis on them, but they're not inherently wrong. They can be helpful within certain bounds. My view is that we need more support for high-tech investment, for education. We should have fewer basket weaving or majors and more engineers. Only 7% of American students study engineering at university versus a third in China and Russia. We used to have the National Defense Education Act in the late 1950s, which gave scholarships for scientific education. We need worker training for skilled workers. I think there's a whole range of policies we need to promote the dissemination of productivity-enhancing technologies, give the private sector incentives.
Professor Hanke, the proposed Mar-a-Lago Accord draws a comparison to the 1985 Plaza, Plaza Accord under the former U.S. President Reagan toward Japan. But both of them are about, to weaken the U.S. dollar. Do you think the government will achieve that with a weak U.S. dollar, weakened U.S. dollar, the U.S. will export more, and then somehow there will be a reindustrialization?
Well, no, I don't believe that will be the case. And if you look at the Plaza Accord, which occurred in 1985, and the period 85 to 90, Actually, we did have a big devaluation, an adjustment with the dollar being weaker after the plaza, but productivity slowed, output growth slowed, and the share of global trade made up by the USA's contribution was smaller. So it wasn't a success. I mean, depreciations and devaluations usually are associated with slower GDP growth, higher inflation, and higher borrowing costs. So this is just not the way to go, in my view. But I don't think it's anything but talk, because as we alluded to earlier, it's virtually impossible for me to see that you get the major countries on board and agreeing to this kind of thing. Mm-hmm. A new plaza, a new Mar-a-Lago, it's just not going to happen politically.
Right.
I mean, you're going to get China to agree to this kind of thing? No, it's not going to happen.
I wonder, are you seeing, what Stephen Miran's proposal about? He suggests that the countries exchange their holdings of U.S. government debt for extra long, century-long, probably bonds and security guarantees. Are other nations, allies, or say like competitors will cooperate? You talk about China. What about other countries like Canada and Mexico, European countries?
The answer is no. Unfortunately, we are in a situation where the president has not been following Dale Carnegie, and he never really read Dale Carnegie's book about how to win friends and influence people. So these kinds of agreements require people like Ronald Reagan and Jim Baker. These guys were artists at convincing people to do things, winning friends, influencing people. They knew how to do this, but that's not the situation now.
Well, on that note, we come to the end of today's show. Many thanks to our guests. You can also find us on the CGTN app on YouTube. Thank you for being with us. I'm Qin Duo. See you next time.